Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Monday, everybody. I hope you had a restful weekend, and I wish you all a productive week ahead. Let's begin. Over the weekend, on Saturday, China announced plans to issue more debt in an effort to stimulate the property market, recapitalize banks, and provide financial support to local governments. This move aims to reassure investors about the government's plans to boost the economy. Indeed, the market, after a roller coaster week in equities trading, had been anticipating the meeting, waiting to see if Beijing was serious about stimulus. Finance Minister Lan Fo-an, during a briefing in Beijing, did not provide specifics on the amount of funding, but hinted that further economic stimulus measures are being considered. He noted that there is ample room for the central government to increase debt and the deficit. Indeed, as we've seen in previous videos, the central government balance sheet appears to be the only one left with enough space. Local governments, state-run enterprises, local government financing vehicles, and even households, once known for being incredibly frugal and high-level savers, all now have massive levels of debt. Investors are clearly watching for signs of increased fiscal spending to complement China's monetary stimulus plans. Chinese stocks fell last week, as we saw at the time, following a press conference where the government planners offered few details about fiscal support measures. Lan mentioned that bonds would be issued to allow local governments to repurchase unused land from developers and purchase unsold new homes. The government also plans to issue a special purpose bond to help large banks boost their capital, enabling them to lend more. Additional support will be given to students and low-income groups, Lan added. However, the Minister of Finance cannot specify the amount of fiscal stimulus until it is approved by the National People's Congress, which is expected to meet soon. The government's actions come in response to declining household and stock market confidence. In late September, China launched its largest monetary stimulus since the pandemic, which initially boosted the stock market, but was followed by a decline after the holiday due to the lack of detailed fiscal plans. We have followed all of this as it has happened. One of the major focuses of the new spending, according to Lan, will be reducing the debt burden on local governments, many of which rely heavily on the property sector for revenue. Economists estimate that China may need to spend up to 10 trillion yuan, $1.4 trillion over 2 years to effectively stimulate the economy, with much of this targeted at households to boost domestic demand. Earlier last week, the People's Bank of China and the Ministry of Finance set up a joint task force. Its first official meeting discussed the maintenance of the smooth operation of the bond market and the central bank's government bond trading. Market commentators were quick to point out that the formation of this task force can be seen as the establishment of a mechanism for coordinating monetary and fiscal policies, increasing synergy between the two. Analysts have been quite disappointed with this Saturday announcement. Alicia Garcia Herrero, chief economist for Asia Pacific at Natixis, expressed concern about the lack of clarity in Beijing's spending plans, suggesting this might not significantly boost the market. Raymond Young, chief economist for Greater China at ANZ Bank, agreed that the lack of a specific number was disappointing to investors. Heron Lim, an economist at Moody's Analytics, mentioned that helping local governments would enable them to increase spending, which could help the economy. However, he also cautioned that the absence of clear figures on stimulus might make investors hesitant. IG market analyst Tony Sycamore was more blunt, telling clients in a note today, quote, "Saturday's briefing by China's Ministry of Finance has turned out to be a flop. The fiscal measures needed to remove downside risk to growth and ignite the animal spirits within Chinese consumers are conspicuous in their absence." End quote. Markets were just as disappointed as the analysts. Even before the Ministry of Finance briefing, after a week of euphoria, Chinese stocks kept their worst week since July last week. On Saturday, head of quantitative investment at CSOP Asset Management Limited, Yi Wang, expressed, quote, "The market is tussling between expectation for more stimulus and the economic realities. Investors want to see a quick translation from stimulus measures into improving corporate earnings, better macro data, whether that's with inflation, employment, or local government debt. But there is a time gap between that expectation and the economic reality." End quote. And on Sunday, Peking University Professor of Finance Michael Pettis posted, quote, "About 7 of my students trade actively in the Chinese stock market, and I asked them during Saturday's seminar what they expected to do Monday. The consensus was that the market would open much lower as disappointed investors left the market, but they would probably buy in the late morning or early afternoon if that happened, because a lower market would put more pressure on Beijing to do something. End quote. So what happened? Well, today during trading, Monday morning, the CSI started up just 1%, before quickly moving to around being up 0.1% as of filming. Very modest versus the surging prices we saw 2 weeks ago. Next up, we continue discussing the Chinese economy, but first we move to a sponsored feature. Sponsored features are limited to just a few a month to ensure that the channel is financially sustainable but still primarily supported by subscribers. If you'd like to know how I work with sponsors, this is in the description below. One of the most interesting and controversial developments in finance in recent years has been the rise of digital assets. Many traditional investors are increasingly interested in having some exposure to digital assets in the higher risk, high return part of their portfolio. However, they want to do so through holding traditional stock assets, rather than dealing with holding digital assets themselves. There is also demand for a diversified holding of these assets. Today's video sponsor, DeFi Technologies, DEFTF, provides an attractive way for investors to do just that. As we speak, the global megatrends we're seeing affect the world in 2024 are directly tied to DeFi Technologies, whose share pricing is surging, up more than 300% in 2024 so far. The company just filed the forms to be uplisted and upgraded to the Nasdaq. One of the most successful cryptocurrency entrepreneurs, Johan Watterstorm, who founded the first ever Bitcoin ETF, is deeply involved with DeFi Technologies. He founded Vela, which is licensed to issue ETPs, exchange-traded products, in the Nordic markets, and just announced that they're expanding to the London Stock Exchange, which is basically the Nasdaq of Europe. Vela uses trading fees, staking, and lending to generate between 8 to 10% on assets under management. Its business is profitable and booming. Vela is a wholly owned subsidiary of DeFi Technologies. Eric Jackson, founder of EMJ Capital, explains his thesis like this. Quote, blended this is 39 times forward PE multiple, which should be applied to DeFi to value the company. You get a current implied share price today of $20.87 per share, end quote. Right now, shares are traded for around $2 a share. One of the earliest visionaries of the cryptocurrency industry is Anthony Pompliano. Pompliano is a shareholder of DeFi Technologies. DeFi Technologies is surging much more than Bitcoin itself too, proving the effectiveness of its business model. Since September 2023, Bitcoin is up 140%, which is great, but DeFi Tech is up 2,603%. In the past 5 years, Bitcoin is up 672%, while DeFi Tech is up over 10,000%. Many are extremely bullish on the company. So far, the company generated $72 million in net income in 2024. As I write this, the average S&P 500 component company is trading at an average PE ratio of 26. At the time of writing, DeFi Tech's market cap is $627 million, which means it is trading at a PE ratio of just 6.5. Not only has DeFi Tech entered London and the United States, but the company also signed a landmark MOU with Nairobi Securities Exchange and SovFi to develop and launch Vela ETPs in Africa. It is moving to every continent. The company is profitable, growing, and very undervalued, with brand recognition and a competitive advantage that is durable. And the market is starting to catch on. Since I first worked with DeFi as a sponsor for China Update back in early June, its value is up over 30%. So congratulations to those who jumped on the stock back then. So we can see some risk with this pick, but potentially high rewards too. DeFi Technologies is a very exciting opportunity for traditional investors to get exposure to this explosive emerging asset class, and as such is worth looking into. We remember that all investment involves risk. This sponsored feature is not individual investment advice. Always speak to an investment professional and do your own due diligence before making any investment decision. A big thank you to DeFi Technologies for sponsoring this episode of China Update. We now return to regular coverage. Next up, according to official data published by the National Bureau of Statistics yesterday, Sunday, China's consumer inflation unexpectedly eased in September, while producer price deflation deepened, heightening pressure on Beijing to roll out more stimulus measures quickly to revive flagging demand and shaky economic activity. The Consumer Price Index, CPI, rose 0.4% from a year earlier last month, the slowest in 3 months. against a 0.6% rise in August, missing a 0.6% increase forecast in a UK-based Reuters poll of economists. In breakdown, food prices rose 3.3% year-on-year in September, an increase of 0.5 percentage points compared to the previous month. Non-food prices were down 0.2%, reversing a 0.2% uptick in August. The consensus is that CPI inflation in China was flat month-on-month in September, coming in below expectations, and would have probably been in deflation without a rise in food prices. None of this suggests any recovery in demand in September. Next up, and finally for today, I wanted to end today's video with an extract from a commentary published yesterday by Arthur Kroeber, founding partner of Dragonomics, an excellent commentator on China's economy and financial system. Indeed, his book, China's Economy, What Everyone Needs to Know, remains one of my favorite books to recommend to people seeking a nice introduction to China's economic system. Now, I do not always agree with Kroeber, but he is a brilliant voice and a deep thinker on the Chinese economy and the Chinese outlook, and so it is worth examining what he says. We now quote selected excerpts from his commentary published with UK-based The Financial Times yesterday, directly. Chinese equity markets have had a wild ride. Major indices surged by more than 30% in the 2 weeks following Beijing's September 24th economic stimulus announcement. They then fell back on fears that the stimulus might fall short. Which sentiment is closer to the truth, euphoria or despair? The answer is neither. Markets were right to see the stimulus announcement as an inflection point and an opportunity to venture back into oversold Chinese assets, but they misjudged the underlying intent, which is to stabilize the economy rather than generate a major re-acceleration. And they underestimated the constraints on stimulus imposed by Xi Jinping's long-run strategy and by policymakers' desire not to repeat past errors. Xi's strategic aims have not changed. He wants to shift capital from the property sector into technology-intensive manufacturing, which he sees as the basis of China's future prosperity and power. Long-term economic growth, he believes, is driven by investment in technology, which will eventually generate high-wage jobs and rising incomes. China's core task is not to maximize GDP growth, but to create a self-sufficient, technologically powerful economy immune to the effects of the US to stunt its rise. This program is cogent as a national strategy, but unfriendly to financial investors. The emphasis on investment means that supply will always run ahead of demand, leading to deflationary pressure, which is bad for corporate profits. Even the favored high-tech sectors face intense competition that will erode margins. Xi has not retreated from his vision, but has accepted a change of tactics. The stimulus decision was driven by poor economic data, including a sharp deterioration in manufacturing sales and employment, a chorus of criticism from Chinese economists, and the rising risk of protectionism against China's exports. Short-run stabilization is needed in order for the long-run plan to succeed, but measures will be rolled out carefully to avoid what policymakers believe were damaging mistakes in previous stimulus episodes. One such mistake was the big infrastructure project of 2008 through 2009, which helped China recover quickly from the global financial crisis, but also began a pile-up of local government debt which rose from being almost nothing 15 years ago to nearly 80% of GDP today, including the liabilities of off-balance sheet financing vehicles. Another was Beijing's cheerleading of a stock market bubble in 2015, which saw the CSI 300 double in a little over 6 months and then give up almost all its gains in 2 months. Xi's government is now determined not to overstimulate the real economy, nor to inflate another stock market bubble. The economic aims are to stabilize growth and prevent deflation from tightening its grip. In sum, the economy and financial returns are likely to pick up in the coming months. In the long run, though, China's vision is unchanged. Technology and self-sufficiency matter more than growth and profits. End quote. We will find out in time whether his observations are accurate or not. That is today's episode of China Update. Please let me know in the comments below what you thought of some of these developments, including this commentary from Kroeber that we just covered. Thank you everybody for watching. Have a great Monday, and I will see you all tomorrow.